We've seen quite a strong growth in volume, both in leveraged loans and high-yield bond activity in Europe through the course of the year so far. So if you look at the run rate versus last year, on the high-yield side, we're running about 2.25 times the volume of last year, and on the loan side, it's over 3 times as much as last year. So if you look at the volumes year to date, we're about just over 200 billion has been issued across leveraged loans and high-yield bonds in Europe year to date, which on a standalone basis, if we ended the year today, and we hope we won't, that would be the third highest year of volume ever in the European market, eclipsing 2020, all years but 2021 and 2017. And the all-time peak was 2021 when we had 275 billion of volume, and already over 200 billion this year with 4 months to play. There's every chance, I think, that we'll have a record level of issuance across loans and bonds in Europe this year.
So precisely looking forward then, how is the pipeline looking for the rest of the year and beyond?
Yeah, encouraging, but it's still not as big as the market would like it to be. So we're tracking just under 30 billion of volume that we've been able to identify between now and the end of the year. But if you look back to that 200 billion number that we've done year to date through August, that's an average of about 25 billion a month. So that 30 billion number that we see between now and the end of the year, frankly, would be, not an overwhelming number, should be very easily digested. What we expect, though, with conditions being as robust as they are and the backdrop being very supportive for leveraged credit in Europe, we would fully expect that calendar will grow through a combination of newly announced M&A activity, but also the continuing of refinancing, which has been the bulk of volume year to date.
So precisely with the interest rate pictures just starting to change, getting a bit lower, the Fed being next very soon, but also a potential economic slowdown on cards, or maybe a soft landing. I don't know what your scenario that you have in mind is. How is that affecting clients and your activity as well?
Yeah, it's a great question, and it's funny. The market seems to be, an inflection point is probably the wrong term because we don't expect the direction to change, but we're given the number of factors at play in this backdrop. It's a little bit difficult for investors and lenders who buy leveraged financed assets in Europe to really have conviction around the direction of travel. Because to your point, while rates are coming down, if we look back just 4 weeks ago, with changes in the economic outlook in the U.S., at least temporarily several weeks ago, that had quite an effect on the market backdrop. Obviously, the impact was felt much more in equities than credit. But it's become more difficult for our investor and lender base to have a really strong conviction about, are we going into a softer economy? Are we going to get to that soft landing? Are rates going to come down at a faster rate or not? So it's a bit of a challenge for them right now to have conviction about how to invest, particularly because we're in a level right now and now where risk spreads in the leveraged finance asset class are extremely tight by any kind of historical metric. So our investors and lenders are actually questioning, are they getting paid sufficient risk premia for the amount of uncertainty about direction from here?
And that nervousness seems to be reflected in the stock market. We've seen the ruts on the stock recently. This seems to be, again, happening yesterday. So a bit of nervousness there. So how are you playing out with this market, and how is that impacting for your activity?
Yeah, again, I think that's very much a reflection of the same type of sentiment. I mean, if you look at the rally that we've seen in our market since roughly a year ago when we hit a peak, we're 200 basis points tighter on our European high yield index than we were in October of 23. And that is a very strong rally when you look at the index is now yielding just under 6.5% in Europe. A 200 basis point rally from 8.5 to 6.5 is a massive move. And I think you're seeing it the same way in equities, where we're at pretty close to all-time highs. That's a nervous time for investors because they feel as if the rally's run about as far as it can, and the upside from here is probably fairly limited. Conversely, if we have two sets of clients. We have the investors and lenders, but we also have the issuers and borrowers who are here considering, is this a good time to access the market? And I think if you sort through all of those metrics about us being at these tight levels, it is an outstanding time to start accessing the market because we really don't have a lot more to rally from here.